What's going on, YouTube family? Welcome to Automotive Life. My name is Lucky, and today we're going to be talking about the auto loan crisis. Now, it's been about 45 days since I made the last video, so I wanted to give you guys an update and tell you what's currently going on in the market. Now, the reason why I picked this specific video for today is over the last 2 weeks, I've been talking to private investors, investment bankers, as well as hedge funds about what's currently going on in the market, how I see it actually going down a really bad road. Now, one of the things that we talked about was everyone thought that it was only subprime, it's people with bad credit, that's the only thing that's gonna affect the auto loan crisis. And that couldn't be further from the truth. I think that people with good credit are gonna be more affected, and how regulatory things are gonna hurt everybody when it comes down the road. And they were all pretty shocked. So I figured this would be a great video to do for you guys and tell you what my thoughts and everything are. Now, just remember, this channel is all about transparency. We want to show as much as we can behind the curtains of the automotive industry. So a lot of things I'm going to talk about are going to be a little crazy, but like I said, make sure if you have any questions, put them in the comment section below. And once again, if you have any questions, comments, any concerns, put them down there. Even if your opinion varies from mine, that's okay. We could still be friends, but I'd love to hear from you in the comment section below. But anyways, now let's go ahead and get into the video because I think you guys are going to be really surprised at what we're going to go over. So before I start the video, I want to make a real quick disclaimer. I'm sick and tired of people always blaming dealers. It's the dealers, it's dealer greed, it's the dealer's fault we're in this scenario. I'm telling you right now, nobody put a gun to your head and told you to pay $20,000, $30,000, $40,000 over MSRP. Nobody told you had to pay 15, 20% on your loan. Nobody told you to put 84 months on a car that's gonna have a depreciation of average of 10% per year. That is 100% the consumer's fault, not the dealers. The consumer. It takes two to tango. So remember this. Every time you get upset and you see these blown over prices and higher interest rates and shorter terms or longer terms, whatever it is, just remember, consumers steer the market. And so everything is based off of you guys. It's a reflection. Now, like I said, this channel is all about transparency and showing you behind the curtains of the dealer side and what they do wrong, but you gotta hold consumers accountable because these people are overpaying. And I know some of you watching this, you're like, well, I don't wanna pay $30,000 over MSRP, and that's why you're being patient and you're waiting for the better deals to come. But this is what's gotten us into this pickle is literally, it's everybody's greed. It's banks' greed, which is probably the worst. Then it's the overall consumer. It's that need as an American buyer to buy something we can't afford to impress people we do not even like. That is what's gotten us here. So keep this in mind as we go through this video. And you're gonna see that this main factor plays a huge part in everything we're gonna be talking about today. Now let's go ahead and dive in about the subprime auto loans. Everybody knows this now. It's been all over the news. My video has been shared, I think like over 1 million times, like on everybody's social media about how the market is slowly collapsing for subprime loans, that they're seeing record high default rates. People are giving up their cars because they can't afford the payment or the stimulus money ran out, blah, blah, blah. We all know this. I've talked about this a bunch of times on the channel, but we're watching this slowly ramp up. So everything we talked about 4 or 5 months ago is still continuing on exactly at the same pace that we talked about. But one surprising thing was the prime loans. Everybody thought that, oh, the subprime borrowers are gonna be the problem, not the prime borrowers. These guys are gonna have no problems. And this is where we're starting to see a turn. A lot of people are losing their cars that are prime borrowers. The reason why is inflation. Now, when they bought the car, let's say the car payment was $703, which is now the average new car price, car payment in the United States, which is absolutely insane. So let's say they're paying $700 for a Toyota Corolla, and they could afford it. But during the pandemic, the rent was, let's say, $1,550. Fast forward, 2022, their rent is now maybe $2,000, maybe even as high as $2,200. I've seen some companies here in Vegas almost double their rent during the last 2 years. So now the rent's gone up. Gas, as we know, is almost tripled. Cost of insurance, cost of pretty much everything else, food is doubled. So now the people that could traditionally afford that $700 a month that were good credit borrowers, due to inflation and what's currently going on in the economy, they can't. And so now they're either forced to get rid of their car or let it go. And that's why when we reported last month, Experian is talking about a 2%, or excuse me, a 4% upgrade from 2% on default rates for prime borrowers. Now that is almost double of what it normally is. That's the big shocking factor. And it's not only that, but this is why I believe that this auto loan crisis is going to get worse, because it's what people owe. Now, keep this in mind. If you paid $50,000 for a car in 2021, you fast forward to 2022, you're thinking, okay, maybe 5-10% depreciation, But what's happened is these banks were lending 150, 160, 170% of LTV. So now that $50,000 car, they're lending $65,000, $70,000 on this vehicle. So now everybody that we know is upside down in their vehicle. So there are three factors that are going to affect a lot of these prime borrowers. First one is they can't refinance it because they're, too upside down in their vehicles. As values are dropping, they can't refinance it. So now they're stuck paying a higher interest rate. We'll go into that one here in a second. Two, they're upside down in their cars. So if they try to go to a dealership and try to get rid of them, they can't. They owe way too much money on their vehicle. So now they can't downgrade, they can't upgrade, they're just stuck. And the third thing is deficiency. This is the number one thing that scares banks, that hurts the actual market. And this is what's going to force possibly regulations when it comes to auto lending, which we'll go into the very end. But first, let's tackle the first one. If you bought a car that was worth $50,000 and you financed it for, let's say, 84 months and you got 150% LTV loan, so now your $50,000 loan is, let's say, $65,000, you owe more than what it's worth. You signed up and let's say just for fun, you got it at 10% interest. Well, now you can't afford your $1,000 monthly payment. So you're trying to figure out, well, you know what? I'm just going to refinance it because I want to be able to keep my car and lower the payment. So you're going to all these local credit unions and they're going to run the book on your car. And they're going to be like, okay, well, I see this car is worth $45,000 and you owe $60,000. We can't refinance it because you're upside down in your vehicle. So we need you to pay the difference so we can go ahead and refinance this vehicle. And a lot of people are not going to have that capital to do that. So what does this mean? They're stuck paying whatever interest rate that they're currently paying now, almost like with the housing market. So if they bought in at 15%, we're like, oh, I'm going to refinance it. Everything's going to be great. I'll write it out for 6 months and I'll get a really low interest rate. That only works if the vehicle value is worth what you still owe on it. A lot of these banks will not be taking these risks. And especially as default rates skyrocket and more deficiencies, which is more important, which is the balance of what they owe compared to what they got to pay off, gets higher, they're not going to accept any new loans. So a lot of Americans are going to be stuck in overpriced vehicles they can't afford. So what is their option? These are the prime people that are going to let them go and go get a different car. Second one we're going to be talking about is, like I said, being upside down in your vehicle. What's the next option? Well, if I can't refinance it, I'm just going to go to a dealership and trade in my car. I'll just get something else that I want. So as a dealer, you show up to my dealership and you're like, look, Lucky, I got to get rid of my car. I can't afford the payments. The interest is too high. I can't refinance it. Take my $50,000 car that's worth $45,000. As a dealer, I'm going to give you less. I'm going to say, okay, well, I'm going to give you $37,000 in trade-in value. So you need to come up with like 10, 15K to get out of your vehicle to give me, and I'll get you in another overpriced vehicle that you're probably going to get higher interest on. And unfortunately, that's what's going to happen with a lot of people. So now these people are stuck in this car. They can't refinance it. They can't trade it into a dealership to get something else because they don't qualify. Their car is overpriced, they're upside down, and they can't even afford the new car payments because they have to roll that negative equity into a new loan. So unless you want to sign up for a brand new car at $30,000 over MSRP at 84 months, you are absolutely stuck in that car. And this is what's going to happen for the next 2 years. That's why I'm saying this is going to affect the market long term. Those people that think that they're going to trade in their cars every 2 years, which is most Americans, they just want to get something new every 2 to 3 years, they can't because they'll be so upside down in their cars, they won't be able to, because as these prices start to come down, their value of their loan is slowly trickling down. And especially if they got higher interest, they're going to owe even more over the longer period of time. So keep that in mind. So this brings us to our last thing, which is our third, which is deficiencies, which is going to affect the market more than anything else. Now, we talked about in a bunch of my videos, if you go watch the last one, about how banks regulate themselves and how they mitigate for risk, because at the end of the day, they don't want to lose money on their books. So what they start doing now is they're shortening term. A lot of the banks took away 84 months. They're going to 60 months, 70 months. They used to do 160, 170% LTV. Now they're doing maybe 110, 120. Some banks are doing 90%. So they're shrinking the amount of money that they want to give you. They're putting caps on vehicles. They may not want to do luxury cars anymore. So maybe a new Mercedes, new Land Rover is out of the thing. But one thing that scares the banks more than anything else is deficiencies. Now, deficiency is when, let's say your car goes up for repo, like these people we just talked about, they're upside down in their $50,000 car, it's only worth 40 grand. When the bank takes it, he's gonna take it to the auction. And a dealer like myself is gonna go buy it at the auction for 35, maybe 37,000. And that balance of what's left over is the deficiency. And the higher the deficiency rate the bank gets, the less money they can lend in the future. So what they have to do now is they're like, oh my God, we're making maybe 3% on this car loan. We're making 5%, 20% on this car. It's going to take them years to get back over, let's say, a 6-month period of losing a lot of these prime customers because of the deficiency, this balance amount of money that's snowballing every month from all the repos that are coming in. So once that happens, banks are going to stop lending. They're going to pull back. And this is what's going to affect the market more than anything. And this is why I am jumping in and trying to do more of a buy here, pay here dealership. I want to create my own bank because for the next 2 years, a lot of these banks are going to be dealing with this deficiency. They're going to have to getting this money off their books. They're going to have to be getting this bad paper, these bad auto loans out of their books. So for the next 2 years, they're going to be in damage control trying to get rid of all this bad debt. Or in the meantime, somebody like myself can jump into the market, steal a little bit of market share for 2 years, build up my books, and then hopefully either continue on doing business or just people like those banks, they get money all the time. They'll wind up just paying me off. But the cool thing is the reason why you have a 2-year window is because a lot of these banks, as they have high deficiencies, their paper doesn't look as strong. So a lot of the hedge funds or even the banks that give them money don't tend to give them money anymore because they're not showing profitable. They have big losses. What their value, their paper's worth compared to what they actually owe the bank starts to skew. And when they see those numbers drop or start to get close, the banks pull back on the other banks. So now the banks can't get the money to do the subprime loans. They can't get the money to do the prime loans until they fix their current books. So this is going to give a lot of people a little bit of time to get into the market. So this is literally a flashback of 2010, 11, and 12. So that's why I'm jumping into the market as we speak. Now, what does this mean for a consumer and a dealer? As a dealer, you are going to get harder and harder to finance cars. You're going to need bigger down payments, shorter term. They're going to want customers with job stability. All the requirements are going to get tougher and tougher to get you financed. What does this mean for a consumer? If you're a regular person and you're trying to buy a car now, don't. Wait. The deals are coming. I'm watching Car Gurus. You can go on blackbook.com. The prices are going down every single week. Just be patient. As these things start to go down, you'll be able to have more bargaining power. Now, the downfall is for consumers, once again, just like the dealers, you're going to have to bring a bigger down payment. You're going to have to show job stability. You're going to have to bring a lot of things to the table to make the banks comfortable to want to do a loan with you. And normally during this time, you probably would qualify for maybe 3%, 4%, 5%. Just keep in mind, you're probably getting an extra 2 to 3 points higher than what you traditionally would because of inflation, because of the cost of money, and also banks are starting to mitigate their risk. So they're taxing everybody. So now that they're having all these deficiencies from the repos and stuff, and they're planning, banks think years. They don't think weeks, quarters, days, they think years. So as they start to see these numbers tick up, they literally have a formula like, okay, well, if these repos continue to go this way, we need to charge the good person, which is you, 3% interest. We're going to charge you 4.5%. And after giving out 1 million car loans, we'll make all the money we made in 2022 from our deficiencies by 2025. That's how the banks think. So little by little, they're going to start offsetting their risk by handing the savings on to the consumer. So just be ready for that. So if you go into a dealership and you're like, I got a 700 credit score, I don't want nothing higher than 3%, and everybody's offering you 4.5, 5%, don't be alarmed. Unfortunately, that's the way it's going to go. Now, there are some dealership-owned banks like Ford Motor Credit, Toyota Finance, that will do some special rates because they just want to move metal and they want to move inventory. So they will always overlend on a vehicle. So be very, very careful. If you get a lot of loan approvals from dealership-owned banks, but you don't get anything from like maybe the local credit unions, Wells Fargo, Bank of America. That's just letting you know whose interest is really at heart and they just want to bury you in a car. But anyways, I want to thank you guys so much for watching. If you have any questions, comments, or concerns, put them in the comment section below. If you have any inside information or you think that the market's going to be different from what I'm saying, put it in the comment section. Even if your opinion is different from mine, that is okay. We could still be friends. But it's very important that I hear from all of you guys because this is what drives this channel. This is what helps me get ideas to talk about and also kind of, like I said, open up the curtain and give you guys a peek behind it on what dealerships talk about, banks talk about, as well as regular consumers like yourselves. But anyways, I want to thank you guys so much for watching. Make sure you smash the like button for the YouTube algorithm. Also, subscribe to us. And once again, follow us on Instagram @LuckyLopez. And we'll see you next video.